This week is the largest two-day reversal we've ever seen. Technology companies, stay-at-home forever stocks, they've all benefited from everyone being locked in their house and looking at their screens. There's been a lot of excitement about the Pfizer results. More stimulus seems likely.
We are post-election, and we thought we'd start off with sort of recapping how things were in the markets as we came into the month of November, and then talk a little bit about what's transpired at the start of November, and then post-election what's transpired, and what we see as trending in the markets right now, because there have been some significant reversals in some of the behavior underlying the market return. So Mike, take us through briefly what happened in October and where the trends are heading.
Yeah, October and really September weren't great months for diversified portfolios. Interest rates were sideways to up, and the equity market, particularly large caps, a lot of volatility and sort of trading in a range, struggling to break through the all-time highs that were posted in late August. So, consistent with our outlook heading into the election, we thought the market would basically be digesting the higher probability of a change in leadership in Washington. And typically when that happens and the market goes through that digestion process, it means you have a lot of volatility, but the market doesn't really go anywhere. So September and October, not great months. Obviously in November, got far more clarity around the election outcome. Still not 100% clarity, but more clarity than we had, certainly. And basically every participant in the market was able to find some reason to like the potential outcome. And then also some very positive news this week on the vaccine front. Monday of election week, the market started to rally as, the polls were predicting this would be a Democratic sweep type scenario, and that a contested election was not a likely outcome. And so we had talked about in our election outlook previously that, there isn't, the market probably won't fear a blue sweep, because ultimately it just means more stimulus. So you had a pretty strong rally day before the election. And as we went through the election, and even on election night, the market really never viewed any of the potential outcomes from this election as bad overall. Futures were volatile on election night, as it went from looking like, hey, this blue sweep got some cold water thrown on it. Oh, now it looks like the polls were wrong. Maybe Trump has a chance. And then more of a divided Congress type scenario is what the market has been pricing in since then. But through all that volatility, you saw some volatility in interest rates and some trend reversals within the equity market. But overall, the market viewed all these potential outcomes as positive. And the rally resumed and picked up a lot of pace once we got through election day. What you've seen, if you look at this month-to-date column, for example, in the market summary, and these numbers are all through 11/10, so first 10 days in November, you can see November has been off to an exceptional start. And you just look at some of these high-level numbers. You look at the S&P 500 up 8.5%. That's great, but what these high-level numbers don't show is the extreme level of dislocation and trend reversals that have been happening under the hood. That's even more significant.
Mike, speaking of trend reversals, this is a great chart that illustrates the small value, large growth trend reversal we just witnessed. It's historic.
Yeah, definitely. We've been looking at the performance divergence between value and growth stocks. We've been talking about that quite a bit. And then, it's not just a value growth thing, it's also a market cap thing. So small value underperforming large growth over the past year by about 50%, 50, which is huge. Biggest underperformance since the height of the tech bubble. So what we've seen this week is the largest two-day reversal we've ever seen. So small value outperforming large growth over the first 2 days of this week by over 13%. That's double any of the moves that we saw when the tech bubble was bursting, which was the last time small value was really struggling relative to large growth, and then reversed and small value outperformed large growth. So have to take notice of this. This is huge. This is the market realizing in a big way that they're offsides and trying to catch up, and everybody rushing to the door at the same time.
Yeah, I mean, it is the spark that hopefully will light the fire to get the market back to some type of more normal valuation metric. And I think let's dig a little deeper into this and look more at those trends on the next chart.
So now taking a little longer term perspective and showing these 3x3 style boxes, Morningstar made these famous. So this is for the US equity market. The rows are different market cap sizes. So the top is large, middle is mid, and the bottom is small. And then left to right from columns, you go from value to growth. So you start out, and these are cumulative returns. We've been talking about value underperforming growth for quite some time. The trend really accelerated at the beginning of 2017. And so in this chart, you can see the 3x3 grid on the left there. You can see small value since 2017 on a cumulative basis going nowhere. Conversely, you look at large growth in the upper right, and you can just see the extreme divergence in performance there since 2017.
And even in the last year to date, I mean, it's just even more pronounced in the 2020 chart.
Exactly. And year to date, that trend certainly accelerated due to quite a few factors that we've outlined in prior videos. One of the biggest ones was the COVID situation. A lot of companies, technology companies, the stay-at-home forever stocks, they're all growth stocks. They've all benefited from everyone being locked in their house and looking at their screens and not going out and actually spending money in the real economy. And so that's been a catalyst for an acceleration of this trend here year to date. And then you can see when this trend started to break up, sort of bottom out, if you will. That was the beginning of September. And that coincides with when the market started to price in a higher probability of a change in leadership in Washington. Mm-hmm. And more blue on the board, more Democrats in office in Congress, and a potential Biden victory. And so the market started to price in, hey, if there's going to just be more fiscal stimulus, not just because of COVID, not just in February 2021, but long term for the next 4 years, if we're looking at more fiscal and deficit spending, and we're looking at a potentially more hostile environment, operating environment for some of these mega cap growth names, what does that mean for the market? So that started to get priced in September. And then obviously what we saw the last 2 days was just historic, a huge reversal. And the catalyst there was the excellent vaccine news from Pfizer, far better than expected.
Yeah, talk about the impact of this sort of change. So the election seems to be one point of differentiation, but the vaccine and the path towards reopening, and it's sort of a two-sided situation, right? Like the path to reopening seems brighter now that we have a vaccine, but case counts are rapidly rising everywhere. And while the vaccine's great news, it doesn't seem like it's going to stop us potentially shutting down more.
Yeah, and if you think about the different sides of this coin here, we think that's a big reason why investors feel comfortable piling into some of these small value names, because the way they're looking at it in general is the science works. The initial vaccine far better than expected, and that's incredible. Ultimately, if you want the economy to reopen, you need a vaccine. At this point, that is the last hope. That's the only way we're going to get back to normal. So that's great. That's encouraging. That was the catalyst. But at this point, given how cheap a lot of these small value stocks still are, investors are looking at it as, hey, this COVID situation right now is getting out of hand. And it's probably not going to change materially between now and year end. And if the situation keeps getting worse, which it most likely will between now and year end, and hospital capacity keeps being absorbed, so more hospitalizations, the only tool policymakers have to slow the spread of this is lockdowns. Mm-hmm. It's more stringent lockdowns. Right. And so that's the other side of this coin, and why investors feel comfortable with that is because at some point bad news becomes good news for the market. And if politicians and policymakers have to impose harsher lockdowns, they are most likely going to face a tremendous amount of pressure to provide more stimulus. Right. And we know that's what the market wants, and we know that's what small cap value stocks want. So that's why investors at this point are probably looking at this and saying, hey, it's asymmetric at this point, upside to downside.
Yeah, it's more stimulus will get me through until use the term back to normal. I think a lot of people have been a little reluctant to use that term, but a vaccine would push us towards some type of return to normalcy or some different normal that would be very productive for economic growth and for stock prices post post virus. Let's take a deeper look at the trends with the virus and case counts and what the projections are looking like.
We'll start off and look at some 7-day moving averages, and these are all through November 10th. And so the dark blue line, what you're seeing there are case counts, so your 7-day moving average of cases, and you'll see this third peak. We're not calling it a first, second, or third wave because this third peak in cases started out actually as the first wave for a lot of rural areas of the country that were less impacted by the initial peaks, the first couple peaks in the virus. But now, this third peak, it's spread. It's not just rural areas. It's in major metropolitan areas and urban areas. It's absolutely everywhere. Record highs in case counts. And you can see now it's growing exponentially. In the initial peak of the virus back in the spring, the growth pattern was more linear, but now it's growing exponentially. So you think case counts between now and year end, unless there's more dramatic lockdowns, that's how this thing evolves. And hospitalizations and deaths typically follow rises in case counts with anywhere from a 7 to 14 to 21 day lag. If this is the last peak in cases, we think investors are going to be very willing to look through it almost regardless of how bad it gets, right. Because they know more stimulus will be coming if it gets really ugly. And then, right around the corner, 6, 9, 12 months, hopefully you get to the point where the data on the virus is so bad that it's only going to get better from here, and the vaccines and the therapeutic news is just going to keep getting better.
Let's throw up this next chart here on distancing, mandated versus voluntary. I think this is a really interesting chart that we've been looking at here. Maybe share with the viewers what we're looking at here.
Yeah, what we're looking at here, this is from the IMF, and what they did is they did an attribution of the reduction in mobility of different countries. So different countries around the world during the first 3 months of their outbreaks, mobility was reduced significantly. People stopped moving around, and you can measure that through GPS data on your phones or whatever other smart devices you have. And so they did an attribution of that and said, hey, why are people not moving? Part of it is government mandated lockdowns. So that's what you see in the blue area. And then the other part is just voluntary social distancing. And you can see in advanced economies in particular, more than half of the reduction in mobility was voluntary. And so that's a situation where you think with how rapidly case counts are rising and are likely to continue through year end, even if politicians are saying, hey, I understand the economic consequences of lockdowns, I'm not going to do it, the public is smart. They're going to be watching the news. They're going to be viewing case counts. They have the luxury of just sheltering in place. So either way you cut it, we're in for sort of tough economic sledding here for the next few months as we go into the winter. Either you get mandated lockdowns and hopefully stimulus, or you don't get mandated lockdowns and the health situation gets worse and people are just going to voluntarily social distance.
And then in either case, you get more stimulus, which is always good for the markets.
Yeah, exactly. Either the politicians are going to react to their own lockdowns and provide stimulus, or they're going to react to deteriorating economic and jobs data because of voluntary distancing. And then they're going to have to do more stimulus. But either way, more stimulus seems likely.
Let's share some of the economic data points that we've been looking at and what our thoughts are around some of these.
Yeah, and this chart really speaks to a lot of what we were talking about with the previous slide, where the economic data that you're looking at right now, you can't look at these traditional trailing economic data points, things like GDP growth, which are for the prior 3 months and are subject to revisions because the economic cycle is playing out so quickly. And you can see in this chart the impact that government mandated lockdowns and then voluntary social distancing had on the economy. In March, everything just absolutely came to a standstill. And so some of our favorite data points we're looking at here, the blue line is open table diners year over year. The green line, the Dallas Fed has put together a mobility and engagement index, which tracks a lot of mobility data that we also like to look at. That's from Google. And then the purple line is TSA checkpoint traveler throughput. So just how many people are passing through TSA checkpoints. And to this point, basically the trajectory of this economic data, these high frequency data points, have pretty much followed the stringency of government mandated lockdowns. So everything grinded to a complete halt. And then as we started to get into late spring, early summer, and you saw phased reopenings across states after that initial wave of cases, you saw these economic data points start to recover. And now you can see they've stalled out and they're starting to move in the opposite direction.
Mm-hmm.
And, and the reason for that, a lot of states haven't had to go back in their reopening. But when that's been the case, there's just been voluntary social distancing. People just looking at the case counts and saying, hey, I'm just not going to go to dinner, or I'm just not going to leave the house. So pretty much regardless of how it plays out, whether there are more stringent lockdowns or not, the trajectory of cases are probably going to get worse for the next few months, and the high frequency economic data points are going to stall out or continue to move lower, most likely.
Yeah, so as that chart shows, I think we're anywhere from a third to halfway back towards normalcy in terms of those activities. And in terms of going backwards, we've gone backwards here, and some of the counties here in the Chicagoland area have actually reversed and are now locking down more. Let's continue the discussion around the virus and look at testing. Testing's been on the increase significantly. It's good news, bad news, right? More testing is good, but it also reveals more cases. So take us through the trends here.
Yeah, so here we have the 7-day moving average of tests administered in the US, and we're at record highs. We're testing more and more every day. Testing somewhere close to how much we should be testing per capita. But this is another reason why, if you look at the trajectory of case counts, why they're so alarming, because you definitely have a resurgence of the virus across the country as we move towards indoor season around the country and schools are reopening and things like that. But that is colliding with a rapid increase in testing. And the one thing we've basically known about this virus from day one is the more you test, the more you're going to find it. And so that's why you've had such an increase in testing. It's certainly better to know it, but when we go back to the impact that news around record case counts have on voluntary social distancing and people's behavior, more and more testing is just going to result in more and more cases, and it's going to result in more and more fear related to the virus. And so people are probably going to voluntarily just choose to cut down on their activity and their mobility.
Right. Actually, the better news is we have not seen a significant trend rise in fatalities.
Exactly. This is the sort of the silver lining here, is that the cumulative rates, so the positive test rate, the hospitalization rate, and the fatality rate have not increased with the second peak in cases or with the third peak in cases. There's a tremendous amount of research and data that shows that really all that's happening now is we're getting back towards a peak level of virus that we had in the spring, but we actually know it because we're testing more. The virus outcomes, so how you would read this chart is, if I were to take a test, the probability of me testing positive is actually lower than it was in the spring, because in the spring you were only testing people with awful symptoms because we had so few tests. Now you can do rapid tests from Abbott and from Roche. You can actually buy rapid tests from Costco. So, the probability if you take a test that you test positive is actually about half as high as it was in the spring. And then your hospitalization rate and your fatality rate are half of what they were in the spring, or even lower than that. So that's sort of the only part of this virus situation that is less scary. Because we have more data, we just know more. The data is seasoned. It's more of a known unknown. People can make more informed decisions about the risks. It's still risky, but they have better data around how risky their behavior truly is.
Let's talk a bit about, perhaps just give us the perspective on the vaccine and what sort of that looks like in terms of when it's available, when it rolls out, how it gets administered, and sort of what the time horizon is when it would be widely applied and thus provide a lot of immunity to return to normal.
Yeah, there's been a lot of excitement about the Pfizer results, but the Pfizer results aren't likely to change the trajectory of the vaccine from now until year end. And the reason for that is the earliest time that the Pfizer vaccine could potentially receive emergency use authorization is sometime in December, maybe late November. But even if that were to happen, then Pfizer has come out and said they could probably only distribute 50 million doses in 2020. And this is a 2-dose vaccine, and it also has to be frozen. And so, it's not going to be the cure-all. The Pfizer vaccine is not going to be how we reach herd immunity. We're not going to vaccinate the population here. They say they can get 1.3 billion doses out next year, but 50 million doses before year end, where you figure you need 2 doses per person, maybe you could start to vaccinate frontline healthcare workers. But aside from that, and then the other thing about this vaccine, about the Pfizer and then the Moderna vaccine, which is right behind it, is these messenger RNA vaccines require cold storage, and so the logistics create a big problem. A lot of countries that are less developed don't have cold chain storage logistics set up. This thing has to be frozen at negative 70 degrees Celsius and thawed and used within 5 days. That's very difficult if you're talking about vaccinating the population. The US has gone out and pre-ordered 4 vaccine doses per American already. We've prepaid for this, and these vaccine companies have been producing these vaccines even before they're approved. So as soon as they are approved, they can be distributed widely. So, even if half of these vaccines that we've already paid for don't end up getting approved, you're still in a position where you could vaccinate enough of the population to reach herd immunity. So there is hope. That is the exciting part. But it's not going to make a substantial difference in the virus outcomes between now and year end.
Right. And there's still a lot of unknown unknowns. I mean, we don't know if the virus mutates, if the vaccine will be effective against a mutation of it. I mean, we don't have any data on that. So the jury's still out, but it'll at least we have some things in our arsenal to fight against this as we go forward. So as we sort of wrap up here today, I think that it's important for investors, our clients, to stay in touch with what's happening and to make sure that they're contacting us with any questions regarding their portfolio or any of the investment decisions. And that as we progress through this, we will be making allocation decisions in the portfolios, and we'll keep you abreast of all those changes.